Hello everybody, in this video I will show you how my stock portfolio has changed during the past year. I made a lot of changes for increasing the quality of my portfolio, increasing the quality of my holdings, reducing the anxiety in my portfolio, and you can learn some good lessons from my changes. So in this video I will compare, let me reduce my face here. I will compare the portfolio I had at the end of 2024 to now at the end of 2025, because you see these are not the same portfolios. You see Evolution was the #1 position at the time, and now it's no longer on my portfolio, completely sold out of this portfolio. The concentration is not the same. I had 16 holdings, now I have 12 holdings. So I want you to draw some lessons from what I have done with my portfolio, because I'm much prouder of the portfolio I have today. I know much more the stocks I have today, and I think I have increased the overall quality of my portfolio, and I increase my chances of outperforming the market with the new portfolio. Okay, in case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, in US equities, in high quality businesses, and I have achieved a performance of 25% per year. And for the moment, I am in line to reach my 25% target for this year. And I'm a public investor. I'm one of the few YouTubers. We have a public portfolio. This is it. You can go on eToro. This is a broker. You can check my portfolio live. You have a link in my description below to check my portfolio. And you have this copy trading activity. Literally, if you don't want to do the work and manage your own portfolio, you can create an account on this broker called eToro and copy my portfolio. You will have the same portfolio, the same performance. This is the best broker that allows this, and you can check my portfolio live to see. I'm just showing proof to tell you I'm not lying. This is my portfolio in real time. You see the prices move in real time. We are in pre-market right now. Okay. So, based on these percentages I have in my portfolio, you see I have 12 holdings. I created this, and I am tracking my portfolio over time. And last year, 2024, I had this portfolio. So let me zoom in a little bit so you see better. And let me put this here, copy, paste. Where can I put it? Here. Okay, fair enough. Here, near. Very well. Okay. Now you must see better. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. I will first walk you through the portfolio I had last year, and I will talk about my current portfolio right now, and you will see the differences. You can already spot I have the white color and the red color. Before I tell you what that means, can you guess what the red lines mean? Well, I will give you a few seconds so you can answer this on your own head. Okay, wonderful. Okay, so in the past, 1 year ago, late 2024, I had this portfolio. You had Evolution as the first allocation, the biggest position, 16% of the portfolio. I built this position at different instances because I first bought in late 2023, like December 2023, and I doubled down and tripled down as the stock went down. So turns out it was my biggest position at the time. Well, lucky me, I sold, and the stock is continuing its way down. Since I started buying, actually, the stock went down. I started the Evolution position here, a little bit more than 1,000 SEK. And now it's 600. So it has been cut by half. It has dropped, and it is now continuing to drop. So I'm very happy so far for my performance that I don't own Evolution anymore, but it has been a painful experience. You have mistakes, and I just get rid of the mistakes like this. So it was the biggest position at the time. The second biggest position was Brookfield. You see that it is now my biggest position. You had Azo, AutoZone, 10% of the portfolio. KNSL, 10% of the portfolio. Google, 10% of the portfolio. These were the core holdings. After this, you had Chubb. I have never released a video about Chubb on my YouTube channel because it is a boring company that Warren Buffett is investing in. This is an insurance play. I bought it just to follow Warren Buffett and because I kind of understand the insurance industry. And since the past year, the stock has done nothing, minus 2% performance. So if you only look at the short term, it was a good decision to sell because I no longer have Chubb in my portfolio. Okay, I also had Occidental Petroleum, which was an oil play, also to follow Warren Buffett, and that I have made videos about Occidental Petroleum, so you can check my YouTube channel. It was 5% of my portfolio, and so far, if I had held my Occidental Petroleum, I would have maybe underperformed the market because the performance has been very bad. On a 1 year performance is minus 16%, and I see no signs of recovery. I don't like the way the management team is allocating capital for this company. I've made a lot of videos about capital allocation decisions on my YouTube channel, and this is one example why I don't trust management teams. Because when I bought Occidental Petroleum, the management team was very clear about what they will do with their free cash flow. It was rewarding shareholders with buybacks and dividends. Top one priority. You wait a couple of months, a couple of quarters, they completely stop the buybacks. They focus on having more debt to do a big acquisition and to dilute shareholders. Well, you have more costs, you have more employees, no longer doing any buybacks whatsoever. So this is why I like when the management teams have a simple capital allocation framework like AutoZone. I mean, it's the same buyback program it's been the same buyback program for the past 20-25 years. And this is also the reason why I don't trust management teams. For some example, some cyclical companies like the oil companies, the oil industry, you can't trust the management team because they don't know what will happen with oil prices. And because they don't control the oil prices, they don't control their cash flows. And because they don't control their cash flows, they don't control their capital allocation decisions. So it's been a lesson that was very painful, and I learned this the hard way. Well, I don't own Occidental Petroleum. You can note that Chubb was in red, Occidental Petroleum was in red. Okay? So maybe you are telling yourself, yeah, in red, these are the positions I have sold. Well, no, because I sold KNSL. Kinsale, this is also an instrument play, and it is not in red. Okay, you go down this list, and I had Meta, 5% of my position. Now Meta is 11%. I bought more Meta during the past year. And because of the performance of the business, if you look at the earnings per share, free cash flow, everything is trending in the right direction. And on a 1 year performance, the stock is up 30%. So yeah, for the moment, we can say it was a good buy. I also had AMR, a coal play, and I still hold AMR, but I trimmed a little bit. At the time, the coal company was trending down and trending down and trending down. And during the correction, I sold a little bit to increase high quality holdings. Okay, so I reduced this position for a coal mine, coal company. It's a value investing play, but I reduced the exposure. Next one on the list is Stellantis. Maybe you know me for being a high quality company guy, but I owned car makers in the past. Look at this, an oil company, a coal company, car maker, and Stellantis was a very surprising experience. To be the shareholder of Stellantis was very painful because it's very difficult to invest in the car industry. I bought Stellantis a couple of years ago, made a fortune on the way up. It was a double here. And then I lost everything. I bought before So I made plenty of money on this one and lost everything. It's not as if I lost a ton of money on this one. It's just I lost all the gains. So it's a matter of missed opportunities. And I sold Stellantis the moment they announced the CEO, Tavares, quitted. I sold Stellantis when they issued a new guidance that was very negative. So when things don't go in the right direction for Stellantis car makers, you judge whether the problems are temporary or not. And for Stellantis, I believe they still have a lot of problems in the future. So I don't want to be a shareholder for these kind of companies that are struggling and will continue to struggle for a couple of years. When I bought, it was very cheap. But now all the cash flows evaporated. So another company I had in my portfolio that is no longer here. Another company I had and I trimmed on the way up was TPL. Well, for this one, I exited at the top. So it's an exit, but a very successful exit because I trimmed on the way up and I sold my remaining position at the absolute top for TPL. So I have been a shareholder of TPL for 4 years, between November 2020 and November 2024, and it was almost a 10x. So my most successful investment, I think, I multiply my money by 8, and this is also the reason I am doing 25% per year. Because of TPL, and it was a very big position at the time, and I trimmed and sold everything I had left in my portfolio at the absolute top. So very successful exit here, no longer on my portfolio. I also had AutoNation. I've never made a video about AutoNation. Maybe my old videos from 2022. It's a car dealership in the company in the US. Lithia Motors, same thing, 3% car dealership in the US. I had Alibaba that I sold at the bottom, unfortunately. Pool Corp that I had in the past, and I'm very happy I sold because the problems are just piling up for this company. It was a small position, but I wanted to get rid of this one, and I plan to buy Pool Corp in the future, by the way. So I sold the position because problems keep accumulating. The stock is going anywhere because the earnings are going nowhere. For the past few years they are struggling, and I want to buy more of this one in the future, but this will be the topic for another video. And the last one was Gravity, okay, a Korean online gaming company, mobile games. They do mobile games in Korea, and I still hold Gravity. Okay, sorry, that was a little bit of a messy explanation of listing of all the holdings I have. I apologize if the explanation was messy, but this was the portfolio I had in the past. What you can see is in red, these are the value plays that are lower quality companies, and in white you have higher quality companies. So value investing was in red, if you want. So I had Chubb, Oxy, AMR, Stellantis, AutoNation, Lithia Motors, Alibaba, Pool Corp, Gravity. 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 holdings that were value plays out of 16 holdings. And the reason why I had all these value plays were several. I thought the US markets were overvalued, and last year I didn't see the incremental benefits of AI, so we didn't see the revenue acceleration for AI. You didn't have the signs that AI was real and tangible. Valuations were stretched, and I didn't see much opportunities. And when you are in this situation, when you don't see many opportunities, it's very easy to go into value plays, value investing, because, for example, you had the Chinese market that was very cheap at the time, car dealerships very cheap at the time. It was very easy, right? And now something changed in 2025 because you start to see the benefits of AI. You start to see the better pricing, better revenue, better efficiency from all these tech companies. You start to see real implementation of AI everywhere. And I saw these signs because I'm a daily user of Instagram, so I know Facebook really well. I've been a shareholder of Meta since 2018. And I mean, it's a multi-bagger for me. I've been a shareholder of Meta for a while now. Since 2018, what was the stock price when I bought? If I bought at 200, now it's at almost 800. It's a 4x. Yeah, something like this. It's a 8-bagger for. It's a 4-bagger for me. Yeah, fair enough. And I saw this firsthand, and I wanted to increase the exposure to Meta platforms, which I did. Now Meta platforms is 11%. The goal of 2025 was to increase the quality of my holdings overall, to increase the quality of the portfolio overall, to increase the margins of the holdings I had, increase the ROIC. So you judge your portfolio based on high margins, high ROIC, AI beneficiaries, fiduciaries, and also you want to be cautious of valuation and you want to avoid cyclicality. This was my objective for 2025, to increase the quality of holdings, increase the moat, high margins, wide moat, high return on invested capital. And I believe now with this portfolio, you only have 2 lines in red, 2 value plays. You go from 9 value plays to 2 value plays. And you see that I increased the quality of the holdings overall. If you look at the margins for this one, you can have incremental margins. You can have a weighted average margins for my portfolio. You compare this one to this one. This one has better gross margins, better operating margins, better ROIC, return on invested capital. This one has companies with the wider moat. You just get rid of Stellantis, get rid of the car dealerships, get rid of the struggling swimming pool company, get rid of Alibaba, get rid of Occidental that is struggling and disappointing investors, get rid of Chubb. By the way, Chubb has not done anything in 1 year, so very surprised by the way. Get rid of KNSL. KNSA, by the way, they just reported earnings a couple of days ago, like 2 days ago. And the results are fine, but you have some threats in this company. I made a quick gain on this company and I sold, and I'm very happy I sold. Every time they report earnings, this is very funny, every time they report earnings, the stock drops and then it recovers. And then you have the next earnings report and the stock drops again. Well, I don't like the way it is going. I don't like the way the company is operating right now. I think the stock is getting cheaper, so I may enter back, but not right now. I don't see the early red flags for this company, I would say. Okay, so you get rid of this, get rid of all the value plays, and this is what you're left with. You have Brookfield as the first position. Google, that was a 10% position and went up so much, now it's the second largest position. AutoZone, which went up in stock price, so it's 12% of the position. This line, Brookfield, this line, AutoZone, are maybe my safest investments I have in my portfolio. These are the most secured way of generating 25% per year, in my opinion. You have a legendary investor called Joel Greenblatt that says something about capital allocation and portfolio management. He says you want your biggest holdings in your portfolio to be the safest ones, and you want your smallest holdings to be the riskiest ones, but they can deliver some good rewards. It's a matter of risks and rewards. The top positions in your portfolio, this is also what I teach my students. The top positions in your portfolio must not be the high risk, high reward ones. No. You want your safest ones. And I believe Brookfield, very safe. Google, very safe. AutoZone, very safe. Meta, very safe. I'm a daily user of Meta and Google. This is definitely inside my circle of competence. AutoZone is a very simple business model, what I call a magical stock, because over several periods of time, I have checked the track record for the past 25 years for this company. They very rarely disappointed. So I checked the track record of the management team for 25 years, and I'm a happy shareholder Okay, Brookfield, same thing. You can check the track record of the company, the quality of the management, the quality of the assets, real estate, infrastructure, AI, data centers. They are very, very well positioned to be one of the best risk-reward opportunities in this market. So I have not trimmed my Brookfield position. I bought Brookfield when nobody wanted to touch Brookfield in 2023. I remember very well. I was working in Paris at the time, and I bought on the way down. The stock has made a split, so split adjusted of 30. Before the split 30, now 20. Anyway, I bought here literally at the bottom once, twice, 3 times, and it was crazy to me that such a high quality compounder was trading at such a cheap price. So far, it's been a double in 2 years and a half. Very happy with the performance, and I think it has very good chances of continuing to outperform the market. It's as if you bought the S&P 500, but better. Okay, when you have a drawdown, it will go down less than the market. And if AI is real in the future, they will benefit largely. Now, Brookfield has a guidance of growing minimum 15% per year for the next 5 years. Seems good to me. I don't think the stock is expensive right now. It's fairly valued, a little bit cheap. I think buying Brookfield right now is not unreasonable. Okay, let me continue. I wanted to start this portfolio by the safest ones. Also, I recently bought Amazon, something that you can sleep on, really. Lam Research, to have an edge in AI. Basically, Lam Research is what I call a perfect capital allocator. I made a video recently about Lam Research. You can check it like 1 week ago, 2 weeks ago. Why Lam Research created a magic formula. Because the revenue growth was okay. Like, I don't know, 7, 8, 9, 10, 13% per year. Like, let's say 10% per year revenue growth. But the margins improved over time. So the revenue has been growing by 10% per year, but the net income has been growing at 20% per year. And the net income per share, earnings per share, have grown at more than 25% per year. Okay? So you start from a normal growth rate, reasonable growth rate, but you become stronger, more efficient. You use buybacks, you use a lot of efficiency in the way the company is being managed, and you grow your free cash flow. And I think the revenue was 10, 12, 13% per year. The free cash flow per share of this company is growing more than 25% per year. So if you fill your portfolio with companies that can grow their free cash flow per share by 25% per year, you have good chances of making 25% per year. Because in the very long term, stock prices will follow free cash flow per share. Lam Research is growing the free cash flow per share at 25% per year. So I'm walking the talk here of what we preach on this YouTube channel. You want to focus on winners. You want to focus on companies that are growing their per share metrics. Lam Research is wonderful. And when I bought Lam Research, it was cheap. You had a PE ratio of what, 17, 18? Very cheap. And now, because AI is real, Lam Research is going to the moon. Okay? A company that was recently added to the portfolio to increase the margins and the return on invested capital, etc., is MasterCard. Because also, at the same time that I wanted to increase the quality of my holdings, I also wanted to reduce the time of monitoring. What I try to say is, I want to have companies in my portfolio. You don't need to watch them. You don't need to monitor them, because this is a tranquility, how can I say it? A relaxing journey, tranquility journey. For MasterCard, for Visa, you don't have to monitor them. You don't have to read the earnings call transcript. You don't have to read the report. You know that this business is growing 10, 15% per year. And you know that when we will have a drawdown in the market, MasterCard will go down less than the market. So it's a defensive play. And I'm putting MasterCard in the same category as Berkshire Hathaway. If you want a defensive play in your portfolio, something that you can buy and just sleep and never look, you buy Berkshire Hathaway. It will be the safest stock in the stock market. And when the stock market will go down eventually, the S&P 500, the Nasdaq will go down, Berkshire Hathaway will go down less than this. So it's a good hedge. It's an arbitrage play. It's a defensive play to sleep well at night. And sometimes you want this in your portfolio. So in my new portfolio for 2025, I'm playing offense with Meta or Google or Brookfield if AI is real. And I'm playing defense with companies like MasterCard. Okay? So yeah, it was a 9% position and I don't plan to buy more in the future. It's the ultimate quality pick because nothing really happens for MasterCard. And I love it. You have efficiency. If you look at the revenue growth rate, the revenue is growing like 10% per year, but they are having extremely high margins, gross margins of 70%, net margins of 45%. They are doing buybacks every year. Look at this. They are buying back 1, 2, 3% of shares every year. The free cash flow is growing every year. Look at this in blue. Blue, free cash flow every year. So if your net income, your profits, your free cash flow are all growing 15% per year, you do a little bit of buybacks, you have no risk of disruption. They will embrace every risk like the stable coins right now. They will embrace everything. They don't have a debt problem. They are paying a small dividend of 0.5%. And I bought this for a forward P ratio of 30 at the time. And I believe the valuation is the same now. So a reasonable valuation, fairly priced, for the ultimate quality defensive play in my portfolio. Okay, something you don't have to monitor. This is something I love, and I have seen no one on YouTube talking about this one. Sometimes you want to buy companies that you don't have to spend time on. I mean, you can buy MasterCard, Visa, and close your eyes. You can buy Berkshire Hathaway and close your eyes. Okay, you know that they are very well-run companies with a proven moat, and nothing can really disrupt them for the moment. Okay, so yeah, the other holding in my portfolio that is new compared to last year is MSCI because the valuation has dropped, and I am very bullish on MSCI for the future. Similarly to MasterCard, you have gross margins of 80%, net margins of 40%. You have revenue up and to the right, net income up and to the right. I will not elaborate too much on MSCI because I made plenty of videos on my YouTube channel. If you want to know, my opinion on MSCI, please check my YouTube channels, check my other videos. I think MSCI is one of the safest bets you can have in the stock market right now, safest investments. And for the past 4 years, the stock has done nothing. So valuation is compressing. You have a re-rating, and I believe now with the forward PE ratio of 28, you are talking about a high quality compounder at a fair value. And this is the reason why I am buying, and I want to buy more, okay? So I want to increase the exposure to MSCI. Another company that is new is Landbridge. Landbridge is an equivalent of TPL that I had in the past. As I told you before, I sold TPL at the top. But in the meantime, what do you do? Because what if Landbridge has better upside opportunities than TPL? What if the stock goes up meaningfully? I have learned that you have a correlation of stock price between TPL and Landbridge. So if TPL is a bubble, Landbridge, if TPL is a bubble and TPL goes down, like when I sold, Landbridge is a bubble and will go down. Let me show you what I mean. For the past year and for the past year. For the past year, this is the stock price for TPL, okay? You have the bubble, I sold at the top, then down, stable, down, stable. Look at the stock price for Landbridge now. Up here, down, and fluctuating, down, stable. You have a clear correlation. The difference is these are similar business models, but TPL is in the oil industry, Waterbridge is in the water industry, and Landbridge is cheaper than TPL. So I swapped my shares of TPL, and a couple of months after this, I bought Landbridge. Okay, so very interesting play, and I increased my position in Landbridge on the way down. So now I'm a little bit down on my Landbridge position. I can check live with you. This is great. I have proof of what I say. This is lovely. Yeah, this is minus 9%. And yeah, I plan to hold, see how the situation moves in the future. But this is a multi-year horizon for Landbridge. I don't expect anything for the next year. I don't expect anything for the next 2 years, I think. I'm just holding this as a small position. I don't plan to make it a core holding, right? But I'm holding Landbridge, and if Landbridge goes down, if TPL goes down, I will buy back TPL. Now TPL has a valuation with a forward PE ratio of 38. That's too expensive for me to buy it back. So as an hedge, I'm buying Landbridge, and so far it has been a good hedge. I'd rather hold Landbridge now than TPL. Okay, let me continue. There is another holding that is quite new in my portfolio. This is Fortinet in the cybersecurity industry, which is another tailwind you will get from AI. If AI changes the world, you will have much more cyber attacks. So you will need much more cyber defense. And Fortinet is here. If you want to bet on the cybersecurity industry, you will have companies that are great, Palo Alto Networks, CrowdStrike, Zscaler, Rubrik, but you will find that all these companies are making acquisitions. All these companies have little margins, low margins, and all these companies are diluting shareholders. Not the kind of investment I like. I like when companies are improving margins, they are efficient, and they are not diluting shareholders. They are doing buybacks, okay? Fortinet is the only cybersecurity company that is growing, that is doing buybacks. So if you look at the revenue for Fortinet, up and to the right, net income up and to the right, free cash flow up and to the right, and they have no debt problem, they are filled with cash, and they are doing buybacks when the stock is cheap. What a marvelous investment opportunity. And I bought Fortinet on the way down when it dropped here to $75. It's not the first time I'm buying Fortinet. I first bought Fortinet in 2020, so I know the company very, very, very well. And yeah, I'm holding and I want to buy more. The valuation is reasonable. And you have extremely high margins and growing margins, gross margins of 80%, net margins of 30%. Now you can spot a pattern to this new portfolio. If you compare the gross margins, the margin profiles of the portfolio of 2024 and the portfolio of 2025, you start to see patterns, right? You avoid the value plays, you focus on companies that are high quality, with a wide moat, and with very high margins, okay? And for AMR, I told you I cut the position by half, from 5% to 2%. I'm still bullish, but that's a value play. And for Gravity, I did not change the allocation. It's a defensive play. It's very safe. They are trading at net cash right now, so very, very safe. Okay, let me check my notes. Yeah, many value plays now, not so much. Now, as you can see, the quality of the portfolio has increased. This year, and also next year and future years, I believe we will have inflation. I believe now the minimum inflation target is 3%. The 3% target is the new 2%. In the past, the Fed and all the governments had a target of 2% inflation rate. They completely abandoned, they gave up on this one. Now it's 3%. So the inflation rate will be between 3% and 4 and 5. So we are living in a world with inflation. How can you outperform the market when you live in a world with inflation? Well, you invest in companies with pricing power. You invest in companies that can increase their prices every year more than the inflation rate. For example, if you look at MSCI is a good example. The inflation rate is 3%, so they can increase their prices by 4% or more. So inflation is not a problem at all for them. How can you judge if a company has pricing power? One, if you understand the business model. Not every business models have a pricing power. Secondly, you can check if the company has high gross margins. Okay, if you look at Fortinet, gross margins are at 80%. This is very high. The higher, on average, okay? On average, higher gross margins mean better pricing power. So I'm sure if you elaborate everything, if you put a weighing average of everything, you compare the gross margins in the last year and this year, now my portfolio has better gross margins, better operating margins, so better efficiency, better margins overall, better net income margins, better free cash flow margins, better buyback programs, better moat, better quality of management, and the valuation is still reasonable. Okay, so 2 value plays. The rest of the portfolio has transformed to being a quality portfolio with high quality holdings. And actually, I like it better. I like this portfolio better because it's much easier to monitor. Last year, I had 9 value plays, which means you have to monitor them like you can monitor a baby at home. I have a theory that babies will try everything that is dangerous at home. If you have a balcony, they will go to the balcony. It's dangerous. If you have knives on the kitchen, it will be dangerous. And babies, for some reason, they want to try anything dangerous. Okay, any parents watching this video will agree. I see value plays like babies. You need to monitor everything they do. You want to check everything they do. You want to check the direction where the company is going. Similarly with micro caps, right? You want to check everything with diligence. Now, with the portfolio I have today, it's much more simple to monitor. MasterCard is not a baby. That's an adult. They know where they're going. Lam Research, not a baby at all. You trust the management team. And by increasing the quality of your holdings, you are much more relaxed in your portfolio. You reduce the anxiety you have. You don't have to monitor everything, to have a lot of stress during the earnings period, the earnings week. You don't have this. You are much more relaxed and you can still outperform the market, right? This year, I'm still outperforming the market and have increased the quality of my holdings. And I think this portfolio has very, very good chances of outperforming the market. And I want to continue to increase the quality of my holdings. For next year, I will continue to increase the quality of my holdings. Maybe I will find better quality companies at a reasonable valuation. Maybe some companies here, their stock price will skyrocket. So I will have to sell them. What do you buy with the cash? I have a lot of companies on my watch list. I don't worry about new opportunities. I will update you guys. But yeah, by increasing the quality of your holdings, you have a better portfolio, you have less anxiety, better performance, much easier to monitor, much more relaxed. The anxiety part is very, very important for most people. You don't want to fill your portfolio with companies which will give you a lot of anxiety every time they report earnings. You want to check everything, the transcripts, to check what the company has said in the past. Same thing for Evolution, right? Last year, I remember vividly, they said they were focused on growth, regardless of margins. And now in 2025, they completely changed their tone, saying, oh, you know what, we don't grow anymore, the revenue is going down, so we can focus on margins now. Yeah, come on, how can you change your tone in 1 year? So I don't like this. I don't want this on my portfolio. I want to avoid to make as few mistakes as possible. You want to avoid stupidity, avoid the mistakes. And by increasing the quality of your holdings, you avoid stupidity. Okay, so that was for this quick video update. But yeah, a lot of things have changed for this portfolio between last year and this year. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. click the first link in the description to get more information. You will get a video, a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.